3 high-yield dividend stocks with a perfect 10 smart score. Markets are feeling a little anxious after a whole year of gains. Inflation is rising, the number of unemployed in the United States is at an all-time high, and the backlog of container ships on the West Coast is a constant reminder that supply chains have yet to recover from the pandemic's disruptions. Taking present conditions into account, Sean Darby, global equities analyst at Jefferies, spells out the worst-case scenario: if break-even inflation forecasts fall, narrowing real interest rates at a time when U.S. Treasury bonds are selling off. Given present prices, such a situation would be extremely challenging for the Sandamp P500. Second, if U.S. economic data deteriorated, earnings momentum slowed, and government yields rose, we would expect U.S. equities to be similarly pressured. Under both circumstances, the psychology of buying on dips would be put to the test. As a result of all of this, the market is favoring conservative stock investments as a buffer against uncertainty. Of course, this takes us to dividend stocks. These are traditional defensive investments that offer investors a two-pronged return: share appreciation and dividend payments. These are dividend-paying firms with yields starting at 7%, and they all get a smart score of perfect 10. Let's take a closer look at it. SFL Corporation. SFL Corporation is one of the world's largest shipowners and ocean transportation players. SFL was founded in 2003 and has grown rapidly since then, with its fleet now consisting of 72 ships and 2 offshore drilling assets. There are 9 tankers, 22 dry bulk carriers, and 41 liners among the ships. The company's ships may perform a variety of tasks: chemical carriers with a tonnage of 17,000 dwt and oil carriers in the Suezmax and VLCC classes, with tonnages ranging from 150,000 to over 300,000 dwt, are among the tankers. Car carriers and cargo ships are among the bulk carriers, which range in size from 32,000 to 180,000 dwt. In recent weeks, the firm has taken steps to increase the efficiency of its fleet composition. SFL sold 7 of its smaller handysize bulk carriers for a total of around $100 million in mid-September. After debt repayment, net proceeds are estimated to be in the $40 million area. In September, SFL agreed to buy 3 Suezmax tankers with a total capacity of 156,000 dwt, as well as long-term operating charters. SFL's contracted backlog will increase by around $140 million as a result of the new charters. Over the last 2 years, SFL's size and diversity of fleet have served to buffer the company from financial difficulties. For the past 9 quarters, the company's revenues have remained consistent, ranging between $100 million and $120 million. The company's top line in 2Q21 was $116.7 million, with a net profit of $19.5 million for the quarter. SFL has paid dividends consistently every quarter since 2004, which is a factor of interest to investors. The firm paid its 70th consecutive dividend payment in 2Q21. This was the 4th consecutive payout of 15 cents per common share. SFL's dividend payout has been adjusted in the past to guarantee that it is covered by earnings. The annualized payment of 60 cents yields 7.5% at the present rate. According to Jefferies analyst Randy Givens, container trade grows by 5 to 6% during 2021 as markets begin to recover from the outbreak of COVID-19, and dry bulk shipping demand growth in 2021 grows by 4 to 5% on global economic recovery, putting SFL in a strong position to maintain its strong share of the ocean-going carry trade. The 5-star analyst also believes that SFL will benefit from a number of catalysts in the coming months, including increased profit sharing from Golden Ocean and Frontline in dry bulk and tanker charter rates, more acquisitions, increase cash flow and diversify the consumer base. SFL Corporation may be able to enhance dividend payments to shareholders and or strengthen its balance sheet by paying down debt if cash flow increases. In accordance with these remarks, Givens rates SFL shares as buy, with a $9 price target implying a 10.5% one-year upside. The company offers an 18% potential total return profile based on the present dividend yield and predicted price appreciation. Based on 2 recent good reviews, Wall Street analysts have given SFL a moderate buy consensus rating. The stock is currently trading at $8.15, with an average price objective of $8.50. For further information, see the SFL stock analysis. Now let's shift gears and look into FSKKR Capital, a financial services firm that serves as a consultant and manager to BDCs, business development corporations. FSKKR is in charge of a portfolio worth $15 billion in assets. The company was founded from the merger of two subsidiaries, FSKKR Capital Corp and FSKKR Capital Corp II, as part of the cooperation between FS Investments and KKR Credit Advisors. FSK has 152 firms in its portfolio, with the majority of its investments in first and second lien senior secured loans. In 2Q21, FSK posted a solid EPS of $5.75 per share and $258 million in revenue. Earnings were much in excess of market estimates. Furthermore, the corporation announced a $100 million share repurchase program in June of this year. FSK pays a high-yield dividend in addition to share repurchases. For the third quarter, the business declared a payment of 65 cents per common share, a 5-cent increase over the preceding 4 quarters. The dividend will annualize to $2.60 at the current rate, yielding 11.69%. This payout is more than 5 times that of peer companies in the broader market. FSK presently trades at 0.855x NAV and an 11.5% plus dividend yield, compared to a comparable group that trades at 1.05x NAV and a 7.1% yield, although FSK is targeting a 9% annualized dividend yield on NAV, better than peer levels, Hecht writes. We feel this is an appealing entry opportunity for a top-tier player in the BDC industry with size/scale advantages and the financial backing of KKR. Fundamental indicators remain healthy, as credit has improved, and quarterly origination trends have been positive, the analyst continued. Simultaneously, we highlight an asset-sensitive balance sheet that will profit if/when interest rates rise. FSK has a moderate buy consensus rating among Hecht's colleagues, based on an evenly split 2 buys and holds each. FSK is presently trading at $22, with an average price objective of $24.33 implying an 11% one-year gain. The company has a potential total return profile of 23% based on the present dividend yield and predicted price appreciation. Enterprise Products Partners. Enterprise Products Partners and Energy Midstream Corporation, is last but not least. This company owns and operates oil and natural gas terminals and pipelines that transport product from Appalachia, the Midwest, the Rocky Mountains, and Texas to Gulf Coast processing, storage, and terminal facilities. Enterprise claims to have more than 50,000 miles of pipes and 160 million barrels of oil and 14 billion cubic feet of gas in storage. Enterprise had a 50-cent EPS on $9.3 billion in revenue in the second quarter of the year. Both were slightly higher than the previous year and in line with forecasts. Enterprise, like many other energy businesses, is a dividend champion. The company pays out on a regular basis and has a high yield for investors. The current dividend is 45 cents per common share, which amounts to $1.80 on an annualized basis and yields 8.2%. When it comes to insiders, there are 2 big buys this month. CEO A. J. Teague paid $498,000 for 23,000 shares, while EVP John Rutherford paid $222,000 for 10,000 shares. Teague now owns more than $49 million in EPD, while Rutherford owns $1.2 million. We think EPD's large asset footprint should allow it to pick off some low-hanging fruit related to the energy evolution theme, particularly around carbon capture and storage and hydrogen logistics, though these projects are a couple years out, writes TJ Schultz, a 5-star analyst at RBC. On the base business, EPD is still leaning into petchem, natural competitive advantages versus midstream peers, and we believe this segment can grab an increasing mix of growth capex funds as EPD possibly selects attractive and accretive growth projects over more buybacks. In accordance with these remarks, Schultz rates EPD as outperform, buy, with a $29 price target, implying a 33% one-year upside potential. This is another stock that has received an unified strong buy recommendation from Wall Street experts. EPD has received 6 good ratings in recent weeks. The stock is currently trading at $21.85, with an average price objective of $28.67 implying a 31% year-over-year gain. If you enjoyed this content, make sure to hit the like button, and subscribe to watch more videos like this. Thanks for watching.